We are now facing a credit crunch which could push our economy into a recession. That's at least according to the Fed President Austin Goolsbee, who today came out and said that our economy is facing a credit squeeze, which is going to slow down the economy. And also, over the weekend, Warren Buffett kind of said something very similar. Warren Buffett over the weekend held his annual meeting, and when he was talking, one of the things that he said is that the era of free money has officially come to an end, and the economy today is very different than where it was 6 months ago, and it's very different than where it was 12 months ago, particularly when it comes to inventories of products and free money. And what he says is many of the companies that he has invested in now have a lot of excess inventory that they're going to have to liquidate, aka sell at a discount. The reason why is because the era of free money, low interest rates is officially over. He expects us to be in this era of higher interest rates for a while, and that is going to cause a slowdown in the economy. And this is where the question is, how bad is it going to get, and what will the Federal Reserve Bank do? Because there's two kind of scenarios here. Scenario one is we see this credit tightening. We see higher interest rates and a slowdown in spending, but it doesn't cause a lot of pain. Maybe we see a mild recession. Maybe we don't see a recession. It just kind of blows over. Option two is we see the slowdown in spending. We see the higher interest rates, which then tips us into a deep recession, at which point either the Federal Reserve Bank can start stimulating, which would make inflation worse, or they can stay strong to let us go through this economy and really work to bring inflation down. So the question is, where is it going to go? Everybody has an opinion, and this is where the question is, what do you do to prepare? Like Warren Buffett, on one hand, is sitting on the largest cash pile ever. I mean, he's sitting on billions and billions of dollars, and one of the things that he said in his annual meeting is that unlike 12, 18, 24 months ago when he was sitting on these billions of dollars, he wasn't really generating a return before. Now, at least while he's sitting on these billions of dollars, he can generate a return because he can get interest on this money, whether it be through a treasury note or a treasury bond. He can get some sort of return while waiting, even though it's still not keeping up with inflation yet, but it's getting some sort of return as opposed to before when there was no returns. And even today, I mean, there are some high interest savings accounts that are paying 3, 4, even some I saw that are paying over 4.5% that are FDIC insured on your savings. So if you have cash that's just sitting there, you might want to consider at least moving some of that to a high interest savings account, because at least you can generate some sort of interest. Although it's not beating inflation, 4% interest on your savings is a lot better than the 0.01% that most traditional banks pay. So that's what Warren Buffett is saying, that he is anticipating opportunities. He's looking for opportunities. He says that we're going to see a slowdown in spending, and that the slowdown in spending is going to create opportunities, because what happens, according to Warren Buffett, is that people doing dumb things creates opportunities. And this is where, when you have that free money, easy access to money, it's much easier to do dumb things and more likely to do dumb things, because when you have easy and free money, you're encouraged to go out and spend. Like today I had a lunch meeting with another entrepreneur that I'm very close with, and one of the things that we were talking about is over the last number of years working with companies, what we've seen is companies were very much incentivized. Startup companies who were raising money through venture capital. Startup companies were incentivized to spend money as fast as possible. Let's say you had a company where you sold, I don't know, these little types of bags, and you would generate $4 for every bag that you sold. Well, in that business model a couple of years ago, if you could make $4 a customer, you were encouraged to spend $5 to get a customer paying you $4. Now you might say that doesn't make any sense. Why? Because the whole idea was you need to go out and grow the market share as fast as possible, even if that means you lose money today, because hopefully they're going to buy something again. And if you can grow the market share, then eventually you'll be able to ease the gas off the pedal, and you'll be able to slow down the spend and become profitable. That was the name of the game 18 months ago and prior, because money was cheap. Venture capital firms could borrow money for 2 to 3%. And they really didn't need that big of a return to double their money. I mean, if they could borrow money at 2 to 3% and they got a 6% return, they have just doubled their money. Now it is a completely different environment, which has changed the game for startups, it's changed the game for entrepreneurs, and it's changed the game for businesses, not to mention the economy. Now, we've been covering all of this in Market Briefs, my free financial newsletter, which is why if you have not joined Market Briefs yet, I highly recommend you do so because it's a free way for you to stay up to date on what's happening in the financial markets. It's a free daily newsletter where my team is breaking down what's happening in things like the economy, the stock market, the housing market, crypto, and the global economy. You can read it in less than 5 minutes every morning. So if you haven't joined Market Briefs yet, I got the link to how you can join down in the description below. But what we're seeing today is a complete shift in that startup space, because now startups are not getting the easy access to capital like before, because venture capital firms, banks, hedge funds, institutions have to pay a lot more to borrow money. Why are they having to pay a lot more to borrow money? Because interest rates are so much higher. And now the interest rates are so much higher, these banks, institutions, and venture capital firms that lend or invest money into companies need to see much bigger returns, because now if they're borrowing money at 7 or 8%, that means you got to bring a 16% return for them to justify their investment. So now they're having to be much pickier. There isn't as much readily available capital, which means the companies are getting less investment dollars. So now company valuations have been falling like a rock because of that. And then you have the spending side, where, again, 18 months ago, anybody could borrow money very easily, and you could borrow a lot of money at a very low interest rates. If you wanted to buy a home, 3% mortgage. If you wanted to buy a car, very low mortgage. If you wanted to put money on your credit card, low interest rates. Even for businesses, borrowing money at super low rates was very common. Plus, the government also created a ton of lending programs to incentivize spending. So businesses and people were able to borrow money very easily accessible money for relatively cheap, which meant spending was booming, because now people could borrow money, you could refinance out of your home, you could buy a big car. People were able to spend money in the economy. People were able to go to the store and buy whatever they wanted because money was so easily accessible. And by money, I mean the actual money you work to earn and credit. So spending was booming. And because spending was booming, our economy was booming. Because now when you go to Sweetgreen and you buy one bowl, now they make money. They don't know if you're spending this money based off of the money you work to earn, or if you're spending this money from your credit card. To them, money is money. That $20 is $20, whether you work to earn the money or whether your credit card is paying the bill and you got to pay the credit card back. And so the more you spend, the more money that somebody else makes in this economic system. So over the last 18 months, we have seen this completely flip. And now the question is, what's going to come next? In a couple of days, we're going to get the next inflation report. And this next inflation report that we get is going to be a big tell as to what the Federal Reserve Bank is going to do. Because if this inflation report comes in higher than expected, that's going to put a lot of pressure on the Federal Reserve Bank to continue raising interest rates. And there is a chance that inflation could come in higher than expected, especially considering that we've been seeing home prices rise, especially considering that we've seen a lot of other things rise, like air travel and other things have been really kind of up and down fluctuating with gas prices. Now we're seeing gas prices start to come down, but a month ago gas prices were rising. So there's been a lot of fluctuations on the prices of things. And that's why the next inflation report this week is going to be a very big indicator of what might be coming next with the Federal Reserve Bank. Plus, we've also been seeing the economy slow down, and we've also been seeing a lot of layoffs happen. So we're seeing a big shift in the economy, and this is where Warren Buffett is saying he's looking for opportunities. And he has talked openly about the importance of patience. What he says is patience. The stock market is a device that transfers money from the impatient to the patient. He has that patient mindset. He's willing to wait. He's looking at opportunities. He's saying that the companies he owns, the companies he's invested in, are sitting on a lot of inventories because spending is down. And at the same time, he's seeing valuations come down. And he's sitting on this huge cash pile that he's saying is now finally starting to generate a return. And to him, it doesn't make sense to go out and spend all of this billions of dollars that he has because he doesn't see that great opportunity yet. And he's looking for the right opportunity. Now, of course, he has to disclose everything that he does, but this is where now you want to be looking for opportunities, being financially educated and preparing yourself. That way you can take care of yourself. You can find opportunities, and you don't get blindsided by what happened. Because like I was saying this morning, the Federal Reserve Bank of Chicago, the president, Austin Goolsbee, came out and said that the credit crunch, or at least the credit squeeze, is beginning. Why is he saying that? Because of the higher interest rates that we're facing. Now, why does a credit crunch or a credit squeeze matter? Because remember, our economy runs on spending. The money that spends and fuels our economy is the money you work to earn, and credit, meaning loans. And so if we see a credit crunch or a credit squeeze, which means less credit, that means now in our economic system, the amount of money has decreased, because money is money that you work to earn and credit. Credit is going down because lending is going down. Why is lending going down? Because one, if people lose jobs, they're less credit worthy. And second, as higher interest rates are out there, people are less likely to borrow money. So credit goes down, which means the overall money supply in the system goes down, which means spending goes down. As spending goes down, that hurts the economy. And this is where now you want to be looking for the opportunity, but you can't capitalize on the opportunity if you're not prepared and if you're not financially educated to do so. And this is where you want to be investing in your own financial education. We'll be keeping you posted here and on market briefs, but this is where you want to be learning, looking for opportunities, because the reality is market crashes, market slowdowns, recessions create more millionaires than any other time, because those are opportunities for people who are prepared to purchase good assets, good investments at a discounted price.